Think you're paying too much in taxes? You probably are. At Gavtax Advisory Services, we don't just file returns, we engineer strategic tax plans for business owners and investors who want to keep more of what they earn. If you're watching this, chances are you're doing well financially. Your business is growing, your properties are cash flowing, but every year you still feel like the IRS takes more than its fair share. Today, I'm walking you through 10 costly tax mistakes we see business owners make every single year, and exactly what to do instead. These are real-world cases with real IRS penalties and missed opportunities. So grab a notebook and stay focused. You'll want to remember these key points. Mistake 1, not separating personal and business finances. Let's start with the most basic but deadly mistake, blending personal and business expenses. A client once ran a profitable online business, but they were paying for meals, vacations, and home improvements from the business account. The IRS doesn't care about intent. They care about documentation. During an audit, they disallowed $42,000 in expenses, triggering back taxes and penalties. What to do instead to avoid these penalties? Use separate bank accounts. Set up a dedicated credit card. Use an expense tracking app synced to your chart of accounts. Implement a monthly review. Your business must look, feel, and operate like a business. Mistake 2, operating as the wrong entity. Are you still a sole proprietor or single member LLC, reporting everything on Schedule C? You're likely paying self-employment tax on every dollar of profit. One of our clients made $180,000 from consulting. After electing the S-Corp status and structuring a $90,000 salary, they saved over $13,000 in self-employment tax alone. How to fix the issue? Use Form 2553 or 8832 to elect S-Corp, pay yourself a reasonable salary. Take the rest as distributions. And here's the bonus most business owners overlook. Making the S-Corp switch doesn't just save on taxes, it instantly boosts your business's credibility with banks, investors, and even potential partners. This one move positions you for smarter growth. Mistake 3, year-end tax planning instead of year-round. This is the silent killer. Most people only meet their CPA in March or April when it's too late to change anything. At Gavtax, our clients work with us quarterly so we can forecast, project, and pivot. That's how we saved one dental practice $57,000 by shifting a major equipment purchase from January to December. Don't wait until tax season to think about taxes. By then, you're just reporting history. Instead, aim to do your first proactive tax review by August, a second deep dive in October, and finalize all major strategy moves before December 15th. This timeline gives you enough flexibility to accelerate deductions, shift income, or invest strategically while it still counts. Mistake 4, ignoring cost segregation on a rental property. Do you own a rental property? If you're still depreciating it over 27.5 years, you're missing out. With cost segregation, you can break the property into components, flooring, electrical fixtures, and accelerate depreciation. We helped a real estate investor with a $900,000 duplex take $180,000 in first-year bonus depreciation, zeroing out their income legally. If your property costs more than $250,000, a cost segregation study can unlock tens of thousands in accelerated deductions, often in year one. It's not just about deferring taxes, it's about using the tax code to maximize cash flow today. For high-income investors, this strategy can be a game changer. Mistake 5, overpaying for healthcare. Without a tax strategy, health insurance is one of your biggest personal expenses, but also one of the most underutilized deductions. If you're an S-Corp owner, you can deduct premiums paid by the company. Use a Section 105 HRA to reimburse family medical expenses. Combine it with an HSA for triple tax savings. A restaurant client spent $22,000 on medical expenses. After setting up a properly structured HRA, they deducted $16,500 in the first year, completely tax-free. Mistake 6, skipping retirement contributions. Too many business owners ignore retirement planning. That's not just bad wealth planning, it's bad tax planning. Consider this. The solo 401k contribution limit for 2025 is $69,000 if you're over 50. Defined benefit plans can go up to $150,000 or more annually for older, high-income owners. Strategy: stack both for massive tax deductions. One of our clients contributed $182,000 in a single year across a solo 401k and a defined benefit plan and saved over $76,000 in federal taxes. Mistake 7, not making quarterly tax payments. If your business is profitable and you're not paying estimated taxes quarterly, you're on the IRS radar. A logistics client skipped Q2 and Q3 payments. They owed $14,800 in taxes and $2,300 in underpayment penalties. What we recommend: use a quarterly tax calendar, April, June, September, and January. Set up automatic transfers. Adjust payments as income fluctuates. Quarterly taxes aren't just a compliance checkbox. They're a cash flow discipline. Get ahead of them, and you'll avoid penalties, reduce year-end stress, and gain real control over your financial rhythm. Mistake 8, no bookkeeping. Oversight, QuickBooks, and bookkeepers are tools, not strategies. We audited a 7-figure e-commerce brand. learned their bookkeeper miscategorized $280,000 in ad spend as inventory, inflating taxable income and resulting in a $102,000 overpayment. Here is the smart solution. Do a monthly reconciliation, get the chart of accounts reviewed, get a year-end CPA-led financial walkthrough. You don't need more data. You need a smart interpretation that turns those numbers into decisions. Without strategic oversight, even clean books can quietly cost you tens of thousands in unnecessary taxes. Mistake 9. Not treating real estate like a business. If you own rental properties but aren't structured like a business, you're overpaying and underprotecting. We created a structure for one investor, having one LLC per property, a holding company S-Corp for management, charged inter-entity fees, and claimed retirement contributions. That strategy saved over $47,000 in taxes and created a legal liability shield. But more importantly, it gave the investor long-term control and audit protection. Mistake 10. Treating payroll like an afterthought. Payroll isn't just about paying employees, it's a tax-critical system. And when it's not structured right, it opens the door to IRS penalties, missed deductions, and unreported wages. We worked with a digital agency doing $47,000 in revenue. The owner paid contractors under 1099s, but the IRS later deemed them employees. They owed $26,000 in back payroll taxes, penalties, and interest. On top of that, they weren't withholding taxes properly for a part-time admin, triggering a wage reclassification audit. Here's how to do it right in the right way. Use payroll software integrated with tax withholdings. Issue W-2s for employees. Use 1099s only for true independent contractors. Schedule salary reviews to ensure reasonable compensation is documented. Especially if you're an S-Corp, smart payroll isn't just compliance, it's protection. When treated strategically, payroll becomes a tool for tax optimization, not just an expense. If you're making over 6 figures and haven't had a proactive tax strategy session, you're likely overpaying the IRS. At Gavtax, we work with entrepreneurs, real estate investors, and small business owners to build tax-smart business blueprints that scale. Visit Gavtax and book your free 15-minute consultation, and follow us for more real-world tax strategies that protect profits and unlock smarter growth. Like, share, and subscribe for more financial firepower.